In my opinion, that could be the number one most important investor metric, and it's not even a financial metric, because cash on cash is a good investor metric to say, did I make a good investment? Cash on equity is saying, is this still a good investment for me? And I don't think enough people are thinking about the cash on equity. And it is hard right now. It's hard to tap into that. A lot of people can't refi right now and still cash flows. Hey, welcome back, everyone, to the Learn Like a CPA podcast. I'm your host, Ryan Bakey, with a special guest, Taylor Jones. We didn't get to connect in Nashville, but we are connecting now. Taylor Jones has acquired over $74 million worth of Airbnb properties. He shoots a golf handicap of 8.9, and he passively invests in his own portfolio through TechVestor, the strategic way to invest in short-term rental investment properties. Taylor, how are you doing?
Great, Ryan. Thanks for having me on.
You worked a sales job, and I guess, how did you learn about short-term rentals if you were working in sales?
Yeah. So, no, I mean, what the benefit was to me ultimately was I had all the time in the world. So had the sales job, COVID hit March 2020. And because we were client facing, so we'd always go meet clients in person, secure contracts. We did a lot of work with the school system. So it's, government related. And they closed the schools and there's no, going to government buildings, stuff like that. So I had all the time in the world. And that's what I really capitalized on. So naturally, like anybody, I started consuming YouTube content. And back in March of 2020, it wasn't as educational or course driven. It was actual like content you could consume. It's obviously most short-term rental content has a back end behind it at this point. So it was a lot easier to decipher, but consume YouTube, read some books, Bigger Pockets podcasts, just studied. So I took all that time that I wasn't working and just studied for all of March, all of April, all of May. And I have been a consumer of Airbnb since 2015. So, me and my wife have stayed in 23 different Airbnbs across the world. So it wasn't like I was unfamiliar with it altogether. I just never looked at it from the host perspective. So just been a consumer, and I was like, cool, I know what it's like to book one of these and how to communicate, but I never studied the metrics. And so naturally I kind of worked my way backwards and figured out, oh, there's some opportunity here. And after about 2 to 3 months of studying, it was kind of like, okay, I'm not one to get sucked into analysis paralysis. I've kind of always had the mindset, I got to know enough not to drown, but you don't need to be freaking Michael Phelps, when you get in the pool. And I think too many people in this space, they study, being like, man, I don't know everything. And they think they need to be Michael Phelps. And my whole thought is you just need to get in there and not drown. Because once you get in, you're going to learn everything you need to become Michael Phelps. But being on the sidelines, you're never going to. So we wrote 5 offers. Fifth one got accepted, bought a cabin 8 hours away, sight unseen. So talk about jumping right in. There's nothing better at that point. I flew up for the inspection though. So rent a car, flew up to Atlanta, rent a car, drove up. North Georgia mountains is where it was. I'm here in Florida. So different state, couldn't drive there. And took a look at it. The inspector was like, yeah, man, like a couple small issues, but pretty good cabin. Nonetheless, went home, game plan the reno, went back up at closing. We swapped out furniture, installed a fire pit, updated the game room, sweat equity to its finest. I'm selling the old couches on Facebook Marketplace, just scrapping, really getting this thing modernized. Listed it on a Tuesday night, I remember, and woke up the next morning, had 4 bookings for over $8,000, and I was addicted. I was like, okay,
Wow.
like this is like, you have that and you're like, okay, like here we go. So that was kind of my foray from sales to there. And kind of like I touched on with you, I was like, okay, this is cool. I'm just gonna, high paying sales job. I'll just do one a year for the next decade. If each one spits out 20, 30, 40 grand in free cash flow, whatever it is, like, cool, I'll own 10 of these and I can quit sales and, be retired at 50, and, sort of that mindset. And man, I was itching. I was like, man, I ain't waiting another year. And so 4 months later, had a chance to get an off market cabin in that same market in Blue Ridge and bought that second one. And it was off to the races. And like anybody, I was broke because I just burned through all my cash. And I'm like, how do I get a third? How do I get a fourth? And that's like really where you start diving into short-term rentals. And that kind of spearheaded my journey.
What were some of the biggest lessons you learned from those first 2 cabins that you'll never forget and you'll always apply to the deals that you do now?
Man, automations and SOPs. I think you come in with a mindset of this is how I'm going to operate the business. And then as soon as you get in there, guests are going to throw you curveballs and you're like,
Mm.
cool, I'm going to plan for that. So, how many automations, what kind of automations, what things to head off? And even today, you think you have everything set up for that next property. Like, cool, I've thought of every possible question a guest can do. Oh, I've got a little 30-second video on how to turn the hot tub on because enough people ask me, hey, we can't figure out how to turn the hot tub on. Boom, put a little QR code there. Hey, we can't work the fireplace because most everybody's from Florida and there is no such thing as a fireplace here. So you think you can head all these off and then something new will come up. And to me, I just didn't realize that I thought I had everything, all my SOPs ironed out. I think operationally, really leveraging automation was something I'll never forget. And it's technically never completed. It's one of those that will always keep being refined. But that was a huge thing I learned. And then from those first two, revenue drivers matter significantly. That first cabin was a 3-bedroom, stare at the trees, wooded loft view. And I didn't know that having the 3-bed, the second one was actually on top of Bear Mountain. According to my cleaners, the hot tub repair guy, the handyman, they all said, oh, this is one of the 5 best views in all of Blue Ridge, Georgia. Like they've been to bunches of cabins, done cleanings, fixes. And so I'm on the top of Bear Mountain, just looking out with a 1,000-mile view, epic property. And the revenue difference between the wooded lot view 3-bedroom and the full mountain view epic was night and day difference. We're talking to the tune of $50,000. One cabin doing 80, one cabin doing $130. And so that taught me that if you can understand what it takes to win in a given market, you can leverage that. So whether it's indoor pools in the Smokies or mountain views mattering that much in Blue Ridge or, whatever it is for that given market, I think buying a less than optimal product is something I'll never do again. So meaning whatever it takes to be an A-level property, which could be location, could be physical features on the outside, could be amenities on the physical property itself. No matter what, I'll never launch something that's not considered an A-level property because owning a B-level property, you're just capped at what you could potentially do. Your upside is shrunk, and I would never want to be put in a box where my upside, my revenue is never going to be above a certain level because I'm limited.
Mm, that makes a lot of sense. Do you still own the cabins in Blue Ridge?
I have liquidated both of them.
Okay. I was thinking about that. Yeah.
The equity run up was stupid. I was listening to a podcast with one of the largest apartment syndicators in the country, and I learned about this concept, ROE, return on equity.
Mm-hmm.
And they actually sold um, something like 2,000 apartment units, quote unquote, at the peak of multifamily, compressed 3% cap rates, like when things were just so frothy and stupid. And the podcast host reached out and said, hey man, like, how did you know that like it was the top? And they're like, we didn't. We just always evaluate our portfolio and we look at return on equity. So for those that maybe don't fully understand, a brief lesson is let's say your property is generating, 25,000 in free cash flow. And whatever your original cash on cash is, which so many people get caught up in, and I'm not as big of a preacher about like cash on cash as many in the asset class are. But if you're sitting there with, let's just say $250,000 of equity, you have a 10% return on equity that you're currently sitting on. Now that 250,000 is trapped in, it was easier to refi that out or HELOC when things were good. But in today's high rate environment, those are hard decisions to make and you're going to nuke your cash flow if you do go refi. So I just kind of looked at my personal portfolio and said, man, I'm always going to monitor return on equity. And if I'm only getting in that scenario like a 10% return on equity, I have to evaluate, can I take that 250 and turn it into a number higher than 25 grand in free cash flow? Based on my skill set and knowledge of this asset class, I knew I could do that. So if I can take a 250,000, buy 1 or 2 new STRs and make more than 25K in free cash flow, then you should do it. So I think a lot of people should really look at their portfolio. And I know a couple really good STR investors. One guy owns 8, and right now he's cleaning out the bottom 2. and he's going to free up about 700 grand in equity because he's owned them. They're both in the Smokies. He's owned them for 3 or 4 years, and he's looking at his total yield. And, just imagine that even if he was, let's just say his return on equity is 10% too, he's making 70 grand in free cash flow from those two cabins, but he's got 700 grand in equity. I mean, Ryan, you're a pretty smart guy in this asset class. I mean, do you think you could take 700 grand of equity and leverage that into however many you want to generate more than 70 grand in free cash flow?
Yeah, I mean, I could get 70 grand in the stock market doing nothing.
Yeah, yeah.
That
No, so you're spot on there.
I don't want to take credit for it, but I did a podcast on this in like summer of 2022. And it was called maximizing your return on equity or something like that. And I broke down each asset class and I said, hey, here's what I'm seeing. If you have a short-term rental and I call it the break even, you're calling it ROE, I call it break even. So I use net equity divided by free cash flow. That's going to be your break even in years. So if I have $500,000 in equity and I'm doing 50K in free cash, my break even's 10 years. Well, what you do is you take 100 divided by that break even in years, and that represents what your percentage on equity is. So, in my opinion, if you have a short-term rental and your break even is longer than 8 years, you need to reposition. Now, back in 2022, I used to say reposition because you could sell refi 1031 HELOC and move some of that equity around. Right now in today's environment, you're probably selling it because there's no if your return on equity is poor to begin with, it's because you're obviously not making enough money. And so leveraging up and pulling money out or HELOCing is not going to solve that problem. You're going to be cash flow negative. So your best option is to sell. So I used to say, hey, if your break even is longer than 8 years, okay, you do 100 divided by 8. That's 12.5%. That's the return that your money is making per year. Well, the stock market normally does 8% on average. Of course, the stock market doesn't have debt pay down, tax benefits, appreciation. Well, it does have appreciation, but that 4.5%, that's your cut for managing a freaking short-term rental. And so if you're not making at least 12.5%, it's got to go. And then for long-term rentals, multifamily, I normally throw that break even around 15 years break even because it comes out to be like a 7.5% or a 7% cash on equity return. But I'm a huge believer of that. That's one of the things that any new client that we take on for tax strategy, we have them fill out what I call a net worth statement. And it breaks down their net worth from like retirement accounts, IRAs, cash. But it also makes them break out their portfolio. When did you buy it? When did you buy the property? Where is the property located? What's your outstanding loan balance? What do you think it's worth? And how much is it generating in cash? And because we cannot help you make a tax strategy if you're going to end up selling the property next year. It's just bad advice to tell you to go do something with that property if you're going to end up having to sell it next year.
Yeah, no, and me really learning on that podcast, and like sometimes you're just forever grateful for those aha moments in your life. And
Mm-hmm.
again, just that's why I try to always consume content everywhere, despite how deep into this space I am and successful and all those things. Always trying to learn because you just never know, and there's always people smarter than me. And as soon as that ROE happened and I learned about return on equity, that was my aha moment. And so I reevaluated my entire portfolio and was like, cool, like it's repositioning time. So, hey, I need to sell. The equity run up was stupid. And yeah, successfully took that and repositioned into higher cash flowing assets. And I think too many people are getting stagnant with what they have. And you need to just look at, hey, take my equity, move on to something bigger and better. And I think I've always joked too is you should be wanting to trade up in this asset class anyway, because the amount of effort to manage a 50K revenue property versus a 150K is the exact same. I'd probably argue it's more work for the 50K because you have more guest turnovers. You have a lower income guest typically who's paying a lower ADR. They're going to, bitch and complain more. And really you want to keep trading up and evaluating, can I get rid of my lowest one? Is there enough equity to reposition this into something bigger? And if you're always just 1031ing and leveraging that same original down payment plus whatever equity gain you had. So like on that very first deal, I got my down payment money back and I had 60,000 worth of equity. So I just traded up a little bit, rolled all that forward without having to come out of pocket. And when I sold number one and 1031 into a different one, I traded 80K in revenue for 125K. So it's the same original money. So if I look back, I'm like, man, I didn't have to come out of pocket with any more cash, but I took an 80K revenue property and now made it a 125. My net yields were way better. So I'm putting more actual cash in my pocket. And when you start thinking like that, you start worrying less about what your original cash on cash is, which to me is just the sexy headline that a lot of people throw around this asset class. Like, what's the cash on cash? And I just throw this analogy right back at people. If you invest $1 and you get 50 cents back, you got a 50% cash on cash, but you have 50 freaking cents in your pocket. I like real dollars. I don't like percentages. I can't take percentages to the bank. I can take real dollars to the bank. So I think once you get more mature in this asset class, you start talking less in percentages and more in real dollars. And you start thinking on an experiential level versus kind of more rudimentary. And that's where I think, really trying to educate people on great concepts. So that's awesome that you kind of had the forefront to do that in 2022. And similarly, I kind of learned about that podcast, I think in late 21 or early 22. And that's kind of when I started, reevaluating my own portfolio was there in 2022. So it's crazy how good minds think alike kind of right at the same time there.
Well, also too, it comes down to the return on hassle. I call it ROH.
ROH, man.
I just sent this email out
Return on headache, return on hassle, pick your favorite.
Are you on my email list? I just sent this email out this morning. So,
dude, I am. I need to go find my inbox is slammed, so I'll see it in there and get a good laugh after this show.
Because that is the number one, in my opinion, that could be the number one most important investor metric, and it's not even a financial metric because you have these people that it's like, yeah, I can go buy two $500,000 properties, and historically the math says if you have two $500,000 properties versus $1 million property, you will cash on cash better with the two 500Ks than the million because there's artificially a cap that a guest is willing to pay to come and stay at your place. But now you have to worry about renting it out 720 days instead of 365. You got two roofs instead of one. You got two cleaners, all these different types of things, and it's double your time. So I always kind of, I don't want to say scoff, but when people who are making $400,000 or $500K a year at their day job and they're going to go buy a $300,000 or $400,000 place, it's like, why? The return that you're going to get on your money for managing the property is going to be nowhere near what your hourly rate is. Right? Like if you're going to spend 200 hours in a property and it's only going to cash flow $20,000, like that's $100 an hour, but you're making 500 grand a year. So you're making $250 an hour at your day job.
It doesn't add up.
So I think if people, cause I agree, cash on cash is a good investor metric to say, did I make a good investment? Cash on equity is saying, is this still a good investment for me right now? Right? Due to the debt pay down, appreciation, and just kind of where I'm at in my situation. And I don't think enough people are thinking about the cash on equity. And it is hard right now. It's hard to tap into that. I mean, a lot of people can't refi right now and still cash flow. So
no, and I had to evaluate that. We really wanted to, and man, I was catching. So we had a 3.75, and when I was evaluating, hey, can I refi this? Rates were at 5.5 and rising. By the time I even tried to submit paperwork to look at an appraisal, it had already climbed to 6, and at that point, it broke in Excel. I realized the two, January, February is kind of off season there in Blue Ridge. We typically just break even, cover, so there's no like huge profit made. I realized I'd start running negative on those deals. And the 40, 50 grand in free cash flow was just no longer, you just absolutely blow it up with a refi. So I was pigeonholed into having to sell. And I think today it's almost impossible to be able to refi and still hold a cash strong position on most short-term rentals, unless you just have like, hey, I bought it 5 years ago and it was in a 2 or 3x appreciation market. I just don't see that, 95% of people aren't going to have that option.
So now you run TechVestor, and you guys raise capital from investors to go and buy short-term rentals across the country. What markets are you guys located in right now?
So we've got spread across two funds right now. So, I mean, we're in Arizona, Florida, Georgia, Tennessee, Virginia, Illinois, Missouri, Pennsylvania, New York, and kind of what we learned from going from fund one to fund two. So, fund one, which started in 22 versus fund two, which started in 2023. We bought 81 assets in that first fund. And what you kind of get the benefit of with all future funds is you get to look back and now you have 81 case studies. So we
Mm,
started seeing what things are working and which things aren't working as well. You also start to see, asset values keep climbing in some of these markets, but revenue's not keeping up. So it no longer makes sense to buy. So it's kind of one of those like we got in right before the club doors closed, and it's like, dang it, like there's no more opportunity here. So Fund two is only exposed to about five markets of those nine, and Fund one is in nine different markets. So those 81 houses are spread out, all single family homes across the nine markets. So kind of what we've learned, and I think that's just more with maturity, is you get case studies, you start seeing what wins, what doesn't. We've also just tend to see that the smaller homes we own, one and two bedroom size properties in Fund one, and the smallest in Fund two is a three bedroom, and we're definitely more skewed towards fours, fives, and sixes right now. And we've just kind of seen as debts increased, as general operating expenses, labor is more expensive, whether you're talking maintenance people, cleaning people, whoever your vendors are, is just more expensive across the country. It's getting harder and harder to make those three bedrooms even pencil. So we're just, buying fewer and fewer of those. And that's just kind of the trend we've noticed at our structure, that a lot more fours, fives, and sixes, because those have the, top end potential. So you just naturally going to grow over 150 properties. You really start to see, and time is our biggest friend right now. So the more we continue to operate and the more we continue to grow, we're just able to learn more and more. And then you get more firsthand data. So everybody talks about AirDNA, Rabu, like, oh, the accuracy, all those things. And I know you're good familiar with John. He's from our data side, and we start getting this firsthand data. And what's kind of gnarly is if we were to try to enter some of these markets today, just based on the secondhand data that's available, you probably would never go into some of these markets. But because we have firsthand data that says it does make sense to go into these markets, we're continuing to double down. So a lot of people scratch their heads like, man, why are you guys still buying in some of those markets? I kind of just let play it off like, oh yeah, no man, it's just us, and because everybody might look on AirDNA or Rabu and be like, man, I'm just not seeing it, and we're like, great, that's a moat for us. The fact that nobody else sees this opportunity, is a great opportunity. But that just comes with progression. Whenever we close the second fund here at the end of the year, and we'll open up our third, now we're going to get to look back at everything from fund one and fund two. So every subsequent portfolio that we open does get the benefit of the previous ones, which is just a huge advantage for both us and our investors. Is more firsthand data, more operational infrastructure. You're more operationally efficient. I mean, I'll tell you, from the day we close to the day we're live, to generate cash flow on Airbnb, from fund one to fund two, we've already trimmed that down by about 3 weeks on average. So you
mm,
talk about opportunity cost. If you have a $400 a night ADR property times 21 nights of potential bookings, you're like, holy smokes, that we just saved, 10 grand in operational efficiency. So naturally, we're continuing to be more operationally efficient in those manners, and all just benefits of scale. Just again, unfortunately, this is a brick by brick business. It is one home at a time. Literally, it's not tech. It's not SaaS. You can't pour gasoline on it. It is a very much a build one at a time business, and just continue to grow.
yeah, not only the missed nights, but then the opportunity costs for having it, paying the bills on it for a month or two and it not being live. What about, so you mentioned funds. So for your investors, are you raising debt, or are they equity partners, or a little bit of both, or how does that work?
Yeah, all debt. All of our debt is, typical DSCR product. No portfolio loan, so there's no cross collateralization. Just something from a risk perspective we didn't want to take on. Um,
Mm,
and naturally, too, we took all 10 and 30-year fixed rate debt, especially when things were cooking there in 22 and 23, and 3-year debt, 5-year debt, 7-year debt, all thrown our way, and definitely would have been cheaper. We could have juiced our returns to our investors, but it wasn't a risk we wanted to take. When you see all the, especially multifamily people who took out very much short term or floating debt in 2020, 2021, and now that's coming due, and they're kind of upside down on their properties, we kind of just wanted to stay conservative. We never want to sell these assets when we're not ready to. I mean,
Mm-hmm.
ultimately, we are going to buy it, renovate it, cash flow it, stabilize it with a rental history, and look to sell, on a 4 to 6 year horizon. But we wanted our debt to support that. If we had, 5 year fixed rate debt, for example, and we're getting ready to sell, and all of a sudden that debt's coming due, if it's not the optimal time and we needed 6 more months or 12 more months, now we're forced to make a decision based on our debt, not based on what's best for our
Yeah.
investors. And so we never wanted our debt to dictate our operational moves. So all of our debt is either fixed for 10 or 30 years so that we have the opportunity and the runway that if God forbid, say there's a major economic downturn or World War III kicks in year four, well, we can just continue to hold these cash flowing assets into year five, into year six, whatever it might be, and then sell at that time when things are better. But not being a forced seller, these are ATM machines at the end of the day, you're spitting off cash every quarter. We want to hold them and sell them when it's the best opportune time for both us and our investors.
Mm-hmm. And that's based on the break even, the cash on equity that we talk about.
Yeah, I mean, it's a combination of factors. When you look at selling, it's it's cash flow mixed with principal pay down, mixed with equity, mixed with opportunity. And there is no exact formula. Hey, if we got the opportunity to sell in the next 2 years or 3 years, like you would take it. Now, obviously, your multiple, your multiple on sale is going to be lower if you sell in year 2 or 3, but time value of money, IRR, is going to be higher. So, it's really, there's no magic secret sauce that says, oh, here in year 3, year 4, year 5, year 6, whatever that number is. But naturally, it's going to start to make sense. And so we're always evaluating the portfolio. We've got some smaller institutions kind of circling the waters. They're intrigued, they're interested, but like anything, it's still growing, still maturing. We're not even fully stabilized to where things are humming, everything's going on a multi-year rental history. It is still a 2.5 year old portfolio at the end of the day. So you're not even fully stabilized. The things that we just launched last week, or the property that I think I posted today, we're 8 properties or 9 properties under renovation right now across the
Mm.
country. And then we have 6 more under contract. So we're still in growth mode. We're not like set in stabilization where, okay, everything's live, everything's building up reviews, building booking lead time, peak ADRs. We're still humming. And now that some of these properties have gone in through 2 years, like we're starting to see year over year growth. Depending on when you launch a property, for example, if you launch a Scottsdale home in the summer in June or July when it's 118 degrees outside, you're kind of, you're launched right there in off season and you're actually brutal. You need to get through that peak February, March, April. And then now all of a sudden that property hits year 2 and it's got reviews built up, it's got traction. Now all of a sudden the average, daily rates that we're fetching in peak season, the second go around, now that it's getting more stable, all of a sudden you're seeing 10, 15, 18% year over year growth. So now the curious thing is, well, what happens the third time around? Does it stay
Mm.
flat? Does it keep growing? Where can you push revenue? So these are all things we're learning. As again, it's still just, even the longest ones that have been around, you're still talking 2.5 years. So it's just still unproven to see where you can push the top.
Another question I had, we were talking about this on Twitter, is um, when you're selling these properties, are they selling based on the sales approach or income approach, or a little bit of both?
So we believe that there will be an opportunity at this scale to sell based on the income. The groups that we've talked to have kind of expressed that it's purely not big enough. So for who we ultimately want to exit to, we've had conversations with some of the potential end buyers, and the common consensus that's been thrown around is things such as, hey, we're not writing a check for anything under 250 million. Hey, we want 500 doors. Take either of those two numbers. Where can you go buy 500 doors, 500 short-term rental doors with one check right now? Doesn't exist. Where can you write one $250 million check? Outside of development, which is going to go take you, 24 months, 36 months, and that's too slow. And even if they wrote us a $250 million check and said, hey, go build us a fund, it's too slow. Like they have much more interest in buying than building because they all want the yields. They all want the opportunities. So if they can come in and just scoop up let's say $250 million worth of stabilized short-term rentals or 500 doors worth of short-term rentals. Either way, we're just too early. We're at the recording of this, we're a little over 150 assets. So we're still 3 to 4 years out from it being an attractive opportunity, but ultimately we do believe we'll have the income approach opportunity to exit. We've seen some very small 10 to 18 unit portfolios already trade now on an income approach. So we don't believe there'd be any reason why a portfolio of this scale with this much stabilization 5 years from now would be able to pull off what's been pulled off on a smaller level by some of these 10 and 18 unit portfolios today.
But you would have to sell the whole portfolio, or however many properties in a location.
Well, since everything's not cross collateralized, we can technically sell them off. So we have three options, and we're going to do whichever one's the most profitable for our investors and ourselves. But the first one is to sell the entire thing to one group, which we believe will be the biggest exit opportunity. But we can also break this portfolio up. So let's just say there's a family office in Florida and we have 80 stabilized short-term rentals in Florida. We can peel off all the Florida properties. Oh, we've got stuff in Pennsylvania, New York, Vermont, our Northeast portfolio or section. You could peel that off to a family office or sub-institutional group. So if we need to peel it off in sections, we can. And as painstaking as it is, if it was the most profitable endeavor, we could go sell off 3, 4, 500 short-term rentals one at a time to, hey, who wants a perfect amenitized, ready to go, like, here you go, just get them off the shelf. If that is the most profitable endeavor, we would pursue that. So we've left ourselves options. So we built for the exit in mind rather than building and then realizing like, oh crap, we need to like change structure or pivot or our debt stack. Everything from day one was built with the exit in mind and leaving optionality. So yeah, we can kind of pursue anything from selling 500 at once to selling one at a time and everything in between.
Have you ever read Stephen Covey's 7 Habits of Highly Effective People?
It is on the to-do list to get to.
That's number 2 is begin with the end in mind. So the way that you were saying that, I thought that you might have read that before.
No, that's good. I've heard the book a million times. It's on my short list. So
I had I'll never forget this. Like I played college volleyball, and we kind of had our version of like a hell week, where the week before we played, we would practice 3 times a day. Like we practiced at 6 a.m., we practiced at noon, and then we practiced later on in the evening. 3 days, 3 times a day, like 5 days straight. And one of the days, my coach had canceled it. He said, "Meet at the library at noon. We're canceling all the practices." And so we get to the library at noon, and everybody's like, "Well, what's going on? Like a meeting or something like that?" He's got 15 copies of Stephen Covey's 7 Habits of Highly Effective People. And he says, "We are not going to do anything except read this. Every single person here is going to read this book today. And that's what we're going to do." And that book, I've now read maybe 3 or 4 times because of how impactful those 7 habits are. And just the way you said, begin with the end in mind was number 2. And I'm grateful that we had that experience. And I'll never forget. Whenever I hear that term, I'll never forget that, man.
That's I might have to move it higher up the list. No, I mean, I've done a lot of like the 80-20 principle, unreasonable hospitality. I think if you're in this asset class, that one comes up a lot. Yeah. Unreasonable hospitality was incredible. So, yeah, no, I mean, it's a combination of business and hospitality and mixing stuff in. So, I'll have to push that one up the list.
What's one more piece of advice or tip that you would give to somebody that's listening, that's an investor?
Man, I think it's, even on a smaller scale, you can still take the same approach of building for the end and do it on a smaller scale. And if you want to leave your W-2, if you want to replace income, retire your wife, like I talk to investors so much and you hear a lot of the same things. I think a lot of people are solving for short-term pain, but it hurts them if they're looking more on a 5 or a 10-year schedule. And sometimes the decisions that you make for 1-year pain are opposite or go against the 5 or 10-year outlook. I think me being a washed up baseball guy, baseball teaches you to take a more macro approach. Football, I would consider more micro. It's play by play. Baseball, you're looking more broad speaking. So I've always really had that great vision for how do we look at things more on a 5, 7, 10 year horizon. As people are trying to build their little mini 3 unit, 5 unit, 10 unit personal portfolios, don't get caught up in, yes, there's short-term pain today and it sucks. You're grinding at that W-2. Your wife is frustrated and you want to retire her. Whatever that case is, make the best decisions to set you up for whatever your goal is going to be 7 to 10 years from now. And to me, I've kind of fallen trapped to that sometimes too, where I'm looking at making short-term, just solving for short-term pains that don't necessarily align there. And that could be affecting in, what type of product you buy, where you buy, how you buy, what you're buying. You're trying to just solve for short-term solutions as you grow your portfolio rather than make long-term solutions. And I think there's so many different opportunities out there to win. And you just need to go find those different ways that are going to align with whatever your personal goal is. So it doesn't have to be this crazy 150 plus unit institutional view, but you can really shrink a lot of those same principles down to, hey, I'm building my own. And I've even learned, and I've been very fortunate to learn. I told you right off the clip, I had the idea of, man, I'm just going to, buy one a year for the next 10 years and own a 10 unit portfolio, and each one spit out 20 to 40 grand in free cash flow. I'd rather own 4 or 5 that make, 70 to 90 grand in free cash flow. And I think if I'm making shorter term decisions that kind of compromise what my end goal is, that I'd rather own 4 somewhat moded assets based on whatever factors that is: location, permit type, amenities, structure, you name it. That's just a way better opportunity. And so I'm kind of personally in reshuffling, when people are like, hey, Taylor, like, what about your personal short-term rentals, for me and my wife? And yeah, I'm kind of repositioning and repurposing myself. And that's kind of been going on for about 12 months. Real estate, it's not equities. Can't just buy them, sell them, trade them, and reposition or rebalance. It does take time. And I think I made some shorter pain solving decisions a couple of years ago. And naturally, my goals have changed too. But now that I feel very confident in what I want to ultimately have for me and my family, I'm not going to compromise on those decisions. So now it's repositioning and, reevaluating. It's kind of like you got to take one step back to go 2 steps forward, that approach. And that's just something I would tell people, because it can set you back 1 to 2 years in real estate because of how slow things move if you don't make the right choice. So that would be a big piece of advice I'd give people.
Oh, awesome, man. Hey, where can listeners of the podcast find you?
Yeah, hang out primarily on Twitter and LinkedIn. Twitter, it's at Mr. Jones STRs. LinkedIn, Taylor Jones. I will be making a conscious effort here in 2024 to grow on the video platforms. Started a podcast too with one of our co-founders, the STR Investing Podcast. So maybe we'll have to have a great CPA on sometime to talk about the tax side of things. So we'll maybe we'll be hitting you up, Ryan, to come
anytime.
join ours.
Yeah, for sure. Awesome, man. Thank you, Taylor.
Enjoyed it.